right. So first thing first, let me make sure this is muted. And first thing first, we'll go over these trades from this morning real quick. We had this crazy CPI news. Normally it didn't even really give us nothing, but it was as forecasted and actually lower right here, but the market reacted to it and we got this huge up candle right here. We didn't get a chance to get in it initially. We got in a buy up here, a little high on SPX, and then another one option was here and another option was here. There were three lines. Yeah, there's three lines here where you could have got in here, here, and here. And we knew it was going to come down, pause at one of these areas. The small entry was here. I told you guys you can get in right here, but I didn't get in right here. I waited and got in down here. I didn't call it out or anything, but we in here and here on this and possibly here. Then we had three entries over here on NAS, two here around this area, but then a last one was called out right before we got off the session. That one's kind of really just sitting around. Couldn't get in US 30 at all. That one just kind of ran. So that's how we set this morning. And then we had this EU trade finally hit the target over here at this order block. I figured we were going to get a rejection right here. The goal was to get this target right here around this area of 1750, and we got it on Q right at this order block, and we rejected. So most of this trade is out for me, and I just got a partial in to see if it's still going to run. I actually want to see this to push up closer to this 50% of this order block and then reject, but we might not get it. That's why I left a partial in right here. But overall, this is reacting like we thought it would. The dollar held near this weekly right here. So we got this rejection, and we also got an order block right here. So this is all lining up basically the way we thought. Even though we got this strong down move right here, that was also based off of that CPI, but then it stopped, right? So I think that it just reacted to this so we can get another push up to get into these areas in this shaded area right here. And before we get a real rejection or real move down, we kind of got some signs right here that it wants to go up, where we got this move right here. It's at an area of rejection. And we started getting down moves, but then we got this up move to trade through it. Same thing right here, started getting rejection, got these down candles, got this false signal that it was going to go down, and then we traded through it. Then we had another chance, false signals to the downside, traded through it, right? So this is kind of showing that this is just gonna be a strong move up for now. So those were the trades we had this morning. Still in a couple of them. Yep, still in a couple of them. Yemi wants to know about order blocks. I think somebody asked that already. I will go over that. So we'll start off. Let me open up the chart. And let's just go with this one here. On order block, to simply put, is an institutional order. It's a series of institutional orders or a single institutional order. You can notice that when you see you use it as an area to take possible trades off of. I'm shortening it, but because it's not an easy answer and it probably deserves its own session alone. So it is, if you are in, if you notice before impulse, you get a single down move or a series of down candles. It will look something like this. You may be in a range where you see a down candle, a series of down candles, a series of down candles, a series of down candles. You want to look for an impulse like this and look for price to return back to that area, and you can usually take a trade from there. In a bearish market, you may see this at a range or in the middle of a range or in the middle of nowhere. And you may see a single up move right before you see price break below those lows and trade back to it to return to it. An example on the charts of this is you can see this is the impulse right here from this low to this high. The last down move of this impulse was right here, this single candle right here. This is an order block right here. You would be looking for price to return to this area eventually at some point to take a trade off of it. There's going to be three areas you need to focus on: the high, the middle, and the low. Those are the primary areas for you to take trades off of. That you're going to get price to come to this area, reject off of it immediately. This is a short term one here from this area right here. Price traded above this, made a high, return, made a low inside of this order block near the 50, near the high, and it traded off of it. Some of the key things to focus on is, we draw this up here, 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 here. This is what the model that you want to consider, right? Your order block is going to live roughly in this area. You're looking for price to return to it and reject from here. This will repeat itself if you make a lower low, right? So in a bearish market, you want to see price either range from here, from this area right here, like we are right now. You'll see the order block made within that. And then you want to see the low taken out of that range and a new low made. Once that new low is made, you should expect for price to return to it, reject, and make a new low from there. In a bullish market, it's going to look like this. You're going to expect for there to price to range within this area. An order block to be created somewhere around here. Once that high of that order block is taken out and a new high is made, you're going to look for price to retrace and return back to it and trade off of that order block to trade through this high to make another high. An example of this again on this chart, bullish order block model looks like this. You may see price break down to this low. You should see one strong move to the downside. You may see smaller order blocks within that range. This may be a single candle or it may be a series of candles. Once you see that, measure the high and the low of the order block. Your high is going to be important because once the high made, if you can take the break out of this until you get another high. But if you don't, you can take the trade out of the order block where the high is taken out when this high is created. You're going to look for price to return to these key levels, starting from the 50 down to the 786. Price should return to those levels. Once price returns to those levels, you need to look for candlestick patterns or rejection in those areas, and you'll get a high probability entry. That's in a bullish market. In a bearish market, you're looking at price, possibly a high has been made, a low's possibly been made. You're looking for the last up move. You may see some strong up moves within that range, or somewhere, or a strong series of candles to the upside. You may see single candles, maybe, right? Once those lows are made, like here and here and here, you're going to look for price to take those out. Once you see that price takes those lows out, you know that that last up move is a potential for order block. Like this one, or this one, right? The low is taken out here on this area. This is your first sign that this may be one. Then this low is taken out over here. That's your next sign. Now a new low is made. Once you see this new low made, you're going to be looking for price to return to initially this order block, because this is the larger one. This is the parent to all of these. If we don't get one to come back, you're likely going to have price come to the 50% of the primary one, or possibly the low of one of these other smaller ones, right? Either way, you should get your, you should start looking for rejection around 50% up to the 786, looking for candlestick patterns and rejection candles in order to get this entry along around this area to take out at least the low or equal to this low, and then down to these areas right here. That's the simplest way to put it. I think we need a whole session about this, because everybody asked me this. So I don't want to take up all the time on this one session talking about order blocks, because I feel like we just keep having this conversation. I do use order blocks. I use them all the time when I trade. This trade off of EU was that. Yes. Like I said, I think we need a whole session that we use to trade off of order blocks. That session, I can probably do that one day, and then I'll drop it in the trading resources, because it's definitely a question that I get all the time. And I think I think that just something that needs to be addressed, because it's something we get all the time. So,
hey, quick
not
question,
so
Corey.
much. Was that?
Quick question. When you talked about, like, once it leaves the, like, so when we take trades off the order block and we can expect it to come back there, when it comes back, is that what they mean by mitigation, or is that something different?
Yes, you can use that as you can use that in that reference as well. On the charts itself, think about this example right here, right? This is you can have this example of order blocks near lows, but you can also have order blocks in the middle of impulse moves. You'll notice them like this random down candle right here, right? And you know this is an order block because this made a high right here, at an area where we could likely see rejection, right? But once we saw this down move happen, rejection, and then price traded above this to get a new high, this became an order block. So it looks like this. It looks like this. 1, 2, 3. That's the new high, right? Once we recognize that this A to B move traded to make above from B to C to make a new high, that's when you know that this is a possible area between A to B that price should return to, like it did over here, right? Measure this one, extend this out right here. There is the entry. Oops. There is the order block. And you got your entry right here as well, right? Here, same thing. Last down move, price created a high, price created another high, price returned to it, got rejection, made a new high, same thing, repeated itself, right? All of these are order blocks, right? You can see it clearly right here where this down move was used eventually. It took it a little while, right? The key factors in recognizing these is knowing and seeing when you have price like this little range right here. This is the last up move, right? You see the low of this last candle right here. Let me zoom in for you. In this case, you have an example similar to what I gave you up from above. This is the primary order block. Oops. Right here. High to low. It's the last up move inside of this range, right? The biggest up move. This is the high, the middle, and the low. But we also have this one and this one, right? If we stretch this out, both of these, right? Stretch both of these out. You can see where the market used this, right? I'm gonna highlight the primary one in red and the smaller one, I'll highlight that in orange. Okay, so last up move, we have rejection. We trade below this candle, making a new low right here. You can't really tell this is a new low, but these, if you use, especially if you are not using this indicator, but this indicator shows you where there used to be a low. You know, I use this indicator, higher high, higher low indicator. Whenever you see a red dot, right, that means that we had a low that looked like this or like this at some point, but it traded through it, right? So we had a new low right here, right? And once we saw that we had this low, that means that this area, the shaded orange area, is a potential area for price to return to and reject. Once we made this low, we made a couple of more lows, but overall, eventually, what happened right here? Price returns to it and rejects from there, right? we at least traded down to our first target. This would have been our first target back here at these lows. Then we had price come back to it again. We reacted to this order block and the larger order block right around the low of the order block. And we got this rejection pattern and setup. And then we got this extension right here, all the way down. If we had had our target set up off of this move, we would have been measuring from this wick to this wick. We would have had a 70% entry right here. We would have hit 0 as our primary target, -2.7, -6.18, and 100%, and even got a little more off of this. So that is what we want to look for. And we trying to take these trades off of order blocks. In the reverse, to the upside, primary order block. Take him and stretch him out. We got a couple of smaller ones. This one. Take him and stretch him out. We will highlight this one, big one, in blue. And we'll highlight the small one in orange again. Okay, so here is an example for a buy, right? Order block, price finally trades above the order block, returns to 50% of the order block. There is your entry, right? This one didn't give you any secondary entry, but on a smaller time frame, if we go to a smaller time frame, this small order block, watch what we can get off of that. Let's see, is it going to be on the hour? Look what we can do on the smaller time frame. So we would have had this entry off the 4 hour, right? But if we come into these smaller time frames, that order block we had off the 4 hour is now this one and this one. And we could have got entries off of these two to get this one, to get this entry right here off of this one to make this high. So several examples of how we can use this, when we can use it, and what to look for. And now you can use the order blocks. You're going to trade from one order block to the next order block. That's basically what just happened here. This order block to that one, to this one, back to this one. And now back to this one right here. And we stuck in between this one and that. And this also, order blocks also give you a clear example of where supply and demand is as well. So that's a different topic and different subject, but they all are conjoined. Supply, demand, consolidation, wick off, all of that is in conjunction with this, all of it. Does that answer everybody's question about the order blocks? Crickets. Crickets.
Yes.
Order blocks. So if I'm a large institution, right, and I want to buy right here, right, I cannot put, let's using random numbers, I can't put 100 million orders in right here, because if I want to buy 100 million orders, I also have to have 100 million people willing to sell them to me, right? So instead of me putting my 100 million orders in, I have to break that up. I have to put some in down here, right here, right here, right here. But in order to put those orders in, I have to create the new sale, right? So if I want to sell, I have to create the idea that people are going to still be selling down here. So what I have to do is I have to force the market down so I can buy the orders up. I have to force the market down with these abrupt sales right here so I can buy the market up. I have to force the market down so I can buy the market up. I have to force it down to buy it up, force it down to buy it up. And eventually that changes the momentum of the market from being bearish to bullish. And then once I see that I got control of the market, I can put the rest of my orders in right here. These are also institutional orders. So basically, all order blocks is the institutions using market manipulation to change the direction of the market. If I want to sell, right? Think about what I just told you. If I want to sell, I have to entice people by pushing the market up in order to sell the market down. I have to entice people here by giving a false buy to push it down. I have to create the new idea that people will be willing to buy here by forcing the market up so I can take the market down. Same thing, force the market up, take it down, force the market up, take it down, force the market up. Nobody else is willing to buy here anymore. Now I can impose the rest of my sale orders. And you know, when it's a institution, when you start getting engulfing candles, engulfing candles, engulfing candles, engulfing candles, right? Those are like key signs that you're dealing with institutional orders, because they're the only ones that can create those. Those are the only ones that can make candles this big. We can't do that as traders, unless we all gang up and do something like the Reddit traders did, but not for currency pairs and indices. So so that, could I explain what a point of control is? Okay, yes, I can. I'll use a different chart. Use AU, AN. So point of control, you want to use this indicator and session volume, right? Let me change something right quick. This is a style of trading called market profiling. Your market profile basically covers your high, your low of trading for the day. And then found inside of this is, let me do one more thing. Just like this. A little darker so you can see. Market profile, right? Within this profile, right, you have a high, you have a low, and then you have, this is the point of control. It's called the point of control because this is where the majority of the orders came in for the day. If we zoom in, there are numbers on these blue and yellow lines, right? And then also, if I hover over this, you can see that this, you look at this indicator as I'm hovering over it, you'll see blue and yellow numbers as I hover over these, right? This will tell you how many orders were placed at this particular price. At this price of 1.04662, that's where the most orders were placed. It doesn't tell you whether or not they were buying sales, but based off of the direction of the market, you can get that bias, right? So it looks like at this particular area, because we didn't go any lower, there was heavy buying at this price around this area. That's the assumption you can make. If we look here at yesterday's market profile, we had this low, this high, right? And we can see at 1.04951, there was heavy selling here. We can make that assumption because we had price pushed down from here. So we sold from here, bought here to stop the buying, right? I mean, stop the selling. Within this profile, right, for just this particular day, you have what's called nodes, right? A node is a peak of volume, right? Right here, right here, right here, right here, and then this little small area right here. These can be significant because they can show a shift in the direction, right? If we see this low right here and this retracement throughout this particular day, we see price retracing, right? And then we start to see volume increase and then decrease near a high. You can assume that this direction can continue to the downside based off of order blocks, all that other good stuff. But then if you're using profiling, you can also see that light trading went on right here. And then we got this move to the downside up until we got to this little small area, a new node right here. And we can see at this node, we see wick rejection. We starting off of this candle, and then eventually we pushed up. This indicator can give you an idea of, also, you can use the point of control sometimes as an area to trade off of, because you're basically trading, if you can see, all right, like this area, right? I got a lot of volume down here. Price is trading above the point of control and eventually rejects it and trades off of it, right? That you can use this as a like moving area of support or resistance, right? And you can use it to get trades off of. Just like if you didn't catch this at the top, you see that price is rejecting, break and close below point of control, you got that sell, right? Break and close above this point of control, you got that buy. Same thing right here. You can use this almost and sometimes as a moving support and resistance, because basically it's telling you throughout the day where is your support or where is your resistance for that particular day as the day goes on, right? This will change as you go to different time frames, because a price on the 4-hour might not be the majority as the price on the 15-minute. And that's simply because within that 15 minutes or within that 1-hour chart, a given price could be different. More orders could go in at one particular price versus a 4-hour time period, where combined for 4 hours, one price might have been the strongest versus what it was on the 15. So today, at this given moment, on the 1-hour, the point of control is at this price right now on the 1-hour of 4661. If we go down to a smaller time frame, we'll notice this might not be the price. You might get a more refined price. It's roughly around the same for yesterday. It was 4661, and now on the 15-minute, it's 4663. So for that, it'll give you a more refined. Right now, on the 15-minute, for now that we've changed over to a new day, new trading day, right now, the point of control is at 4641. You can already see as it stands, right? We pushed up, rejected it, right? And now we just got a shift. Actually, we just got a shift on this from below price that could possibly push this up, but it's early. So it's pretty early, right? You don't know how this is going to play out yet. But if you're looking at it, right, price pushed down to this low, rejected, pushed up from here, and now the point of control is sitting right along where price is. So you could say, if we see the point of control below where price is, that is implication that we want to go up until we see the point of control above price or above the low, right? So this is something you want to back test. I have some stuff on this. This is like a little job that I did, basically explaining the same thing. Flip-flop these. I put these in the wrong place, but definitely, like even in this example, point of control was here. You see price hold around this low. We finally got a price to break above it. We even got a trade off of that until we got to this area. It held around here. So I'll send you guys this chart if you want to go into that. And then if you want to learn about this indicator, you can use this. Christopher Terry is who I learned this from, he uses it, or he used to. I don't know if he still does. I haven't watched this session in a while, but he uses this to trade with, and is pretty successful because you want to be where the majority of the people are moving, right? If they're in the right direction, right? And that's what this is giving you. That's what this gives you, the direction of the majority. So I hope that explains everything. Let's see. And this morning, the point of control on NAS was here. It was actually around this little area right here. And until we got this little huge 15-minute candle. And then once we got that 15-minute candle, it actually shifted to this top side, and that's what pushed it down. And then once we got down here near this monthly, we start seeing price hold up right there. And that's why it shifted back to this area right here. And that's why I was comfortable with calling this last trade once I realized the point of control has shifted down here, because we can see that it stopped. In over here on US 30, you can see how they used how the point of control was used over here. It was down here near the daily opening, near the weekly, right? And then once we got this breakout, the market tried to sell off right here, but US 30 wasn't ready to go down. So it took a lot of new orders that were, the majority was here. We can see it a little bit if we zoom in. And let me turn this on to gray. Oops. Put this on gray. We can see, oh, dang it, undo. We can see right here that we had a lot of volume trading right here, and we had a lot of volume trading over here. But let me do one more thing. Two. Okay. So initially, this was the biggest node for the day right here and right here, right around the daily opening price, until we got this impulse that kicked us all the way up here. And as the market tried to sell down, right, that's what this bearish candle is representing, right? They, in order to keep it from going, a lot of new buy orders had to go in. They came in around this price at 468 right here. 468. Yep, 468, 35, 468, right? And that's what kept it from going down, because the point of control is right there. So that's what we are referring to when we're talking about point of control. That's what we're talking about. And that's how we use it. So hope that answered that question. Chin wants to know, when am I going to trade HFX? I don't know. I don't know. I don't have nothing against it. I just haven't, I got an account that, when I'm bored, I'll play around with it. but I don't know. I don't know why I don't. You want to hop on me and you?
Yeah, I'm down for it, man. Whenever, man.
We can do some back testing.
Absolutely.
And I got like a little $300-400 account, and we can play around with it.
All right, cool. I'm down with it, man.
Uh,
Corey,
cool.
smart. I love your teaching, man. And with binary, with what we know with Forex, to me, I find that if you know how to find smart money, that's kind of the better way to like take a handful of trades, knowing that, you pretty much know where the market's going when it touched the smart money and shoot up, and be in and out, with your 3% or 5% for the day
On HFX.
on HFX. Other than that, this one is just like a slow grind compared to HFX, but it's a good one, versus, so it's all depends on, how much you want, how much committed you are, but HFX will make you lazy.
It'll make you lazy.
It'll make you lazy, man.
Really?
Yeah. I feel like I'm learning Forex all over again every time.
I don't know, man. I like my indices, man. I like indices, so we'll see. I will definitely hop on with y'all one day, and we can back test some stuff. I gotta try it out on my own and see how I would trade it, but you know. Brian, discuss trading divergence. For example, B if it's in a downtrend on the MACD, but an uptrend on the chart. How do you know the direction of where it should go? MACD, haven't used that in a long time. Let me.
I'm gonna challenge you, Corey.
I mean, I used to trade it. So it's not hard. I have actually have some drawings that I did a long time ago. Let me see if I can find it right quick.
I did try to trade, I forget the educator on the thing. It's Dr. Lee. He actually teaches really well with divergence. And there's an indicator that kind of like a cheat sheet help you see it. Like it'll tell you bear, and it lines it up. So that way you're not being fooled to go the other way. I just haven't done it in a while.
Send it to him. Send it. Send the link.
Or I'll look for it. I'll have to look for it. But I'll send it to you, and then you could, or Brian, I'll send it to you through Telegram.
Yeah.
And Corey as well, so you can share it with the rest of the class.
Yeah, I can't find it right now, but I can go over it real quick. The way that I can go over the way I used to use it. Hang on, let me see. I know I got it somewhere. All right, I won't dig anymore. So the way I use it is I look for these peaks, right? In this case, this peak. You have your bearish, because we below the zero, we're considered bearish. You consider it a reversal because at this point, during this time, the market's momentum is to the downside, right? Even though we have motion to the upside on the MACD, this is implying that as we see the volume slow down and we are reaching a certain area on the chart for potential rejection, we can see that we have price at the zero. If we get price crossed over the zero, we turn bullish, or we have the potential to turn bullish. Yeah. How can I explain this a little better? For me, I just waited and looked for price to cross zero. I wait for the divergence to happen where you have price either going with the direction of the market, like we have right here. This is probably, if it's going in the direction of the market, but we're in a downtrend, that's probably a sign of a reversal, like we got right here. So we have price going in the direction of the market. We have an uptrend in the market between this area right here. Price slows right here, and this uptrend of volume starts to teeter in this area right here until we have the crossover to the downside. That starts this down move right here. And we have our divergence within this area right here until we reach this low. Now, like I said, as far as trading this, when you can tell when you have a shift in direction, if overall you see we are in a downtrend, right? And you want to recognize, hey, is this a reversal or is this just a pullback? You can notice that once this crossed zero, we don't have that strong of a push up, right? Just like here, we have price pushing up, but the overall market still going to the downside. So the momentum still to the downside as we drop over here. We are below zero between this area, here and here. We're below zero between this area, right here and right here. We know this is a pullback because first we had this huge down move. We crossed zero right here, but we didn't get price to raise above any of these previous peaks over here. Or even over here. We don't get a rise above or another cross of zero until we get to here, around this area. This is just another pullback, retracement. The next time we get another cross of zero is right here. This is when we finally get a change in direction right here. We cross zero, wick rejection, push the market up. But we also know overall we in a downtrend. So instead of us looking for buys in this area, we should be looking for sales to continue, because this is still giving us bearish divergence all the way along this. I can take you through this, but I haven't traded it in a while, so I'm kind of like talking a little out of order, out of context, because it's been a while. But you primarily want to look for the zero cross with MACDs, get a sense of the direction from the impulse of the most recent impulse. Find that recent impulse, determine where is the MACD telling you that impulse is. In this case, between this leg, this high, this low, the impulse and the MACD is showing divergent, showing that you have momentum to the downside. Your divergence needs to come from your retracement, where I have upward motion, upward motion. I have divergence once I see that we have failed price action here to the downside over here, and momentum continues. So we can probably do a little more of this if you want to on a small session where we have like the team meeting or something, right? But like I said, I haven't traded in a long time, and I don't want to leave anything to question. So, and trading with Bolinger Bands. Bolinger Bands are pretty much moving averages. And there is your primary, I don't want to use this one, but there's your primary average, and then there are extremes. And the way you can use this is this middle moving average shows you the trend. And your higher, the average above price shows you potential reversals. The lower shows you the potential reversal for the buys, right? So if I'm trading my averages, you're going to look for price to break this average, the middle. There's a term that I'm probably not using. Again, I don't trade it, but I do understand how to use it. But you can use this average as a means for entries, direction of price as well, right? If I want to know whether I see price, if I see price above this moving average and in between the high, I can wait for price to return to it. If it rejects, I can take the buy up to this moving average. I can look for the sell if I see price reject the high moving average. And I can also look for the sell if I see price break and close below the moving average of the low. This is the simplest strategy I can give you with this. I don't typically trade it. I just know it and understand it. What periods for these moving averages? Let's take a look. Let's take a look. 20. Standard deviation. The basic, the upper band, and the lower band. It's not telling us on here. It's not telling us on here. I'm seeing that it's using the 20 though, for sure. The 20. I'm not sure what the lower band and the upper band is. Let's see. Here we go. The middle band is a 20-day simple moving average. The upper band is a moving average plus a standard deviation. And so is the lower band. So it's all depending. Now you can adjust this, of course, but default is the one that we just use is a 20-day moving average with the standard deviation plus or minus 2. Now, this is definitely something you can adjust to your trading strategy. But like I said, I don't trade with it. I just know I know a simple trading style you can use with it that I just went over. I've tried so many different trading styles, so many different strategies and stuff just to get this stuff. That's why I know a bunch of crap, because I done tried everything. So I know what I like, I know what don't work, I know it work, I know it could, like all of this stuff can work, you know. It just depends on what works for you. So are order blocks like consolidation areas? No, they are not. They can be created within consolidation. However, you can have order blocks within consolidation. You can have order blocks randomly placed. They can be a single candle. There is no, there's nothing that says that it is consolidation or it has to be within consolidation. Let me find an example of one that's not in consolidation. I just saw one, but I wanted to show you a better one. Let's go to the daily. One that is not inside of consolidation. This one was, that's still not a good example. This one right here. This one is just randomly placed. On a lower time frame, it's in consolidation, but in this higher time frame, we're not consolidating. We just randomly pause in the middle. Another good one is this one right here. Just randomly placed up candle in the middle of this down move. That's another good example. Same thing right here, randomly placed down candle, randomly placed up candle. Those are order blocks. Randomly placed down candle in the middle of this huge up move. That's also an order block. US 30 might have created one right here. This random down candle right here. This might be one too. Just gotta wait and see how it plays, how it trades off of that. So you guys basically want a whole session where it's just order blocks, explaining order block. Is that correct?
Yes.
Yes,
Is that-
sir.
Okay. I will do that session on next week. So that way I can prep for it. And I'll record it and I will drop it into the in the resources tab. So anytime you hear somebody got a question, you know you need to send them over here after that. Okay.
Okay.
And when I drop the link for it, and y'all better like and subscribe after that.
Corey, I subscribe to you in your channel, and I'm looking for it, and I can't find it anymore.
I'm about to drop this video for this how-to session. So I'll give you the you can get the link from there. So any more questions? Anybody got anything else?
I'll say this. I look forward to your order block. I mean, I never really use it, but I'm sure it's a good tool, especially since you use it. And I try to mimic a lot of what you, Wale, Travell have went over. But I will tell everybody from my experience, and it's small, you know, compared to yours and a lot of other people, is that, you know, it is one tool, you know, like it's almost like building a house. You got the roof, but you also have the kitchen and the bathroom and everything else. And so all of those tools make the house. So, you know, don't count on just that one tool. You know, use a bunch of other tools in terms of confirmation to build that house.
Yep. Yeah, just because you see price there, you see price at an order block, doesn't necessarily mean that it's gonna go from there. That just gives you a high probability that it will. You still want to look for candlestick patterns, rejection, you know, those kind of things as a confirmation.
Definitely.
You still want to use those. It just puts you in a high probability area, right? That's where it does. Yep. Anna said it right. The most important tool is candlestick patterns and recognizing momentum, right? Because see this is an order block right here. We eventually came back to it. We would have gotten this one trade off of it. Now, don't get me wrong, that is a great trade, right? But if you had to try to use it again, what happened to your trade? Got taken out, and got taken out bad too, right? So they only use this order block once to trade to the upside off of it. And you would have got a move that would have gave you quite a bit of pips, right? About 86 pips. But you also, if you had to try to use it again, you know, let's measure him. When it came to the middle, it never gave you any confirmation using candlestick patterns that it was going to turn around right here. No wick rejection at 50. It did give you one off the low, right? You got these up candles. So you got some confirmation that it might push you up from the low of the order block. And that's okay if you got in right here, because even if you got in right here, you still had an opportunity to get in the trade down here and get some pips and at least either get taken out at break even or with some profit. That's the main reason why I like these kind of setups, because usually if you trade in these kind of setups, even if you're wrong, you'll have an opportunity to get out of the trade with a break even or some profit. That's the main reason why I like these setups. A lot of times when you trade at the break of structure, you are probably going to get taken out because you're going to be getting in at a high or at a low. And a lot of times price will have to, it has to come back to that point. So that's pretty much what I am looking for, and what you should be looking for. Okay. Okay. I hope that was answering everybody's question.
Ooh, can I add something to what you just said, Corey?
Sure thing.
So I don't know if I know they talk about like the markets being fractal, and so I don't know if if everybody knows what that means, but I mean pretty much what happens on the smaller time frames happens on the bigger time frames, or whatever happens on the larger time frames happens on the smaller time frames. So, for example, you might see like on the indices, right? It'll like today we weren't able to get in because they just shot so fast. But maybe if we went down to like the 5 minute, you might see a pullback and a retest of like a support, I mean, or resistance, depending upon which way it's going. So sometimes what you'll see is like if we're trading S&P, and I'm sure everybody's probably seen it before, you'll see like it'll break it, and then on the 15 minute it'll retest it, right? So sometimes what you'll see it'll break and retest on a 5, right? And then you'll get an immediate shoot up. And then it'll come back and break and retest. It'll retest it on the 15, and then you'll get another push up. And then even sometimes, like you said, like if it, depending upon where it's at, if it created like an order block, it'll come back to that area on a 1 hour, maybe could be hours later or whatever. So that's kind of what I wanted to add to that. So a lot of times, when you talked about like if it breaks structure, so you get a break in structure where it'll shoot through something, depending upon what time frame you traded on, that could be a good entry if you got it on the 5 minute. But just keep in mind, it's probably going to retest it. So if you're able to get out of that trade, because I know a lot of scalpers will maybe scalp on like the 5 minutes, they'll get in on that 5 minute retest and they'll take it down, and they'll keep their stop loss really close if they're trailing it, but then they'll get out of it because they know it is going to retrace back kind of to that area and retest that support or resistance. And then you could potentially get in on the second entry again if you got out of the first trade. So I just wanted to add that.
Yep, that's right. You're right, though. You're
So
right.
as homework, if anybody wanted to see, wanted to back test that, if you go, you can do it in indices, you can do it anything. Just go to where it broke that trend line, and then like go to the 5 minute, and you'll see a retest on the 5 minute. And then, you can see even on the 15 minute, it's retested it probably, after a period of time later. And then sometimes even on the hour, it'll come back to that same area and bounce off and shoot up.
Also, I mean, you pretty much said exactly what needs to be said. Back tested. Like everything that you said, back testing this will give you everything you need. Back testing. Hours and hours of it. I'll send you guys this too. Back testing. It's all it boiled down to. And on that note, I will go ahead and send you guys this. We'll go ahead and stop this. And